life insurance, it really has a couple of purposes in our minds. Number one, life insurance, as you are raising kids, have a family, you've got debt, you've got mortgage, you've got all these things that you're doing in your life. Your family depends on your income, and life insurance during that stage of your life is for income replacement. And as Scott alluded to, the more insurance that you can buy for the least amount of premium, generally term life insurance is the best thing for you in that era of your life. As you get older, historically, Janet, it has been a philosophy of ours that you need less insurance as you get older, but governments have a way of changing thinking on that, and we have found that life insurance is taking on a whole new life, if you will, in this era of the Secure Act.
It is, and it's all because of the nuances of taxes. So you have different pools of money, if you will, that are going to go to the next generation if you're not here to utilize those funds. So you have your money that came from your 401k, the majority of which is probably pre-tax. There may be some Roth dollars in there, but for most people, you're going to have a significant amount of 401k, traditional IRA type money, which means that when it goes to the next generation, when they pull it out of the account, not at the time of inheritance, but when they pull it out of the account to utilize those funds, it's taxable. In the past, prior to the Secure Act, they were able to stretch that withdrawal over their lifetimes. They could take it all at once if they wanted to, but they weren't required to do that. So by stretching it out over their lifetimes, they would take a smaller amount each year, and there was a lower tax impact. Now they're required to take that out within a 10-year period of time, and the issue is it's going to add to their already taxable income, whatever they have as ordinary income already. This just gets stacked on top of it. But life insurance, guys, goes to whomever, the next generation or whoever your heirs are, it goes to them tax-free. So if you're still in a position where you're insurable and can get an insurance policy, then that insurance money will go to them without it being taxable, and the IRA money can go maybe to a charity instead.
Yeah, and you've got a lot of complexity that is entered into the equation here. And so life insurance, we think from a tax standpoint, makes some sense to pass along to your kids as opposed to an individual retirement account. But also, we have found, Scott, that the life insurance, as we've talked about on the show just a little bit ago, the hybrid type of life insurance policy that provides for an equal amount of long-term care coverage in terms of death benefit, that long-term care pool of money can come in very, very handy to offset those healthcare expenses in retirement.